If you're an options trader, then you know that there are these things called the Greeks. But what exactly are they? Why do they even matter? Essentially, options Greeks are a way to measure an option sensitivity to the ever-changing external factors that influences the markets. So we're going to look at 3 of the Greeks that we find important here in NetPicks. Make sure you hit like and subscribe. Any questions or comments, you can always pop them below. And the ones that we find most important are delta, gamma, and theta. And each one of these is going to measure a different aspect, and they impact a different aspect of your position. So what is delta? Now, delta is a measure of how much your options price will change in relation to a change in the price of the underlying asset. Let's just say it's a stock. So for example, let's say you own a call option on XYZ stock, and it has a delta of 50 cents. This means that for every $1 move up in the stock price, your option will gain 50 cents or $50 for the contract. So if this stock goes up $1, your call option will increase by 50 cents. If it goes down $1, your call option will decrease in value by 50 cents. Remember, that's per share, 100 shares in one options contract. It's important to note that delta values, they range from 0 to 1 when we're talking about calls, and 0 to -1 for puts. So if you have a call with a delta of 0, that just means it's insensitive to changes in the underlying asset price, and it's not going to move at all, no matter how much your stock price changes. If you have a call with a delta of 1 or -1 for puts, that means it's completely sensitive to changes in the price of the asset, and it's going to move dollar for dollar. Let's put this into general practice with an example, and we're going to look at the $42.50 strike price for a call. We will use a delta of 0.6019, which is 60 cents. And let's just say the underlying price is $42.50. So if your stock price goes to $43.50, so up $1, the value of this contract will go up $60, right? 60 cents times 100 shares. Now note that this green background, it represents in the money options. You also notice they have a higher delta because there's intrinsic value in these options. If this was a put option, I want you to just imagine the Greeks are the same, and the underlying went down $1, well, you'd also make $60. So why does delta matter? Well, you just look at the price and get a pretty good idea of how sensitive it is to the underlying. Well, maybe you can with experience, but deltas are going to give you a more accurate picture because they're going to account for things like time decay and the changes in the volatility of your stock. That's going to impact your options price. And as we get closer to expiration, the delta is not going to be as high as an expiration date that's further out in time. When you get closer to expiration, the next 2 Greeks are going to have a larger impact on you. Gamma is the rate of change of delta for every dollar change in the underlying price of the asset. Think of gamma as fuel on a fire. It represents the acceleration at which an options price will increase or decrease. So you can also think of gamma as what the next dollar move in the underlying is going to be for the option. So in its simplest form, the gamma measures the option sensitivity to changes in the asset's volatility. So how active the underlying stock is. A high gamma position is going to be more sensitive to changes than a low gamma position. So we're going to use the same example as we did with the delta. The first $1 up in the underlying makes you $60. We talked about that. The gamma is going to increase that with the next dollar move up. So now let's say the stock price goes from $43.50 to $44.50. The delta pays you another 60, but now we get the acceleration with gamma, and that's going to pay you an extra $4. So that's 0.0434 times 100. So the first dollar increase in the underlying, you just made $60 extra. The second dollar increase in your underlying stock, you get the $60 plus the $4 of gamma is $64. So when your stock goes up $2, you made 60 plus 60 plus 4 for a $2 move. So a $124 increase in the value of your options contract. Now the same is true to the downside. If your underlying stock is going down in price, a $2 drop, you're going to lose $124 of value. And as we get closer to expiration, our gamma risk increases. Now that could help us or hurt us. So if we're in an options position that is out of the money, the gamma risk can allow us to recover much faster if that stock or the ETF turns around and makes a big move in our favor. So if you're in an options position and that stock moves quickly in your favor, the gamma is going to help you make more money. Theta, very important, and this is referred to as time decay, and it's measured in dollars and cents per day. So for example, let's say you want a call option on XYZ, has a theta of minus 10, right? So minus 10 cents. This means that for every single day that passes, your option is going to lose $10. Remember, options contract contains 100 shares of underlying. The clock starts ticking the moment you enter an options trade. Now, theta, we can use this to gauge the sensitivity of an options contract because it affects the most important thing, and time is extrinsic value. Now, the effect of theta is more pronounced in the last few days before expiration. Well, that's just because there are fewer and fewer days that are remaining in which your underlying asset can move enough to offset the time decay. As your expiration gets closer, theta becomes more negative, and you're going to start losing more money each day. We go back to our real life example using the exact same strike price of $42.50. Theta is negative 0.0134. That means every single day, the value of this contract is going to decrease by $1.34. And that is regardless of how strong your underlying instrument is. Your stock could be rallying. It doesn't matter. There are other Greeks, but these are the ones that we find most important. Now, this is just an overview of the Greeks, and I hope it helps you better understand your options and the positions that you have. Remember, each Greek is going to represent a different factor that can affect the price of an options contract. And when you understand how each works, then maybe you can make more informed decisions about the trades you're going to take. Now, Greeks are dynamic. They're going to change over the course of the life of your contract. Now, the Greeks aren't going to make or break your options success, but we do find the most important aspect is the effect of time decay on our positions, as well as the volatility of the underlying instrument. As a rule of thumb at NetPicks, we generally look at trading in the money options with at least 20 to 40 days of expiration. So we do this so our contract has intrinsic value the moment we get involved in it, and we have extrinsic value because we have lower theta as we wait for the underlying to make the move. Now, our one-day options trading strategy, what that does, it gives you the freedom to trade today and exit tomorrow. And we want to help you achieve your financial goals, especially with options. So I want you to download our 2 favorite markets, plus our unique one-day options trading strategy guide. It's totally free. The link is above and below. Thanks for watching. Make sure you like and subscribe. We'll talk to you soon.